is to simply use the low from the prior week. Okay, so here would be support, here would be resistance moving forward. I'm going to go ahead and leave this level on there just because I think it's going to be a powerful zone from this level here, which remember was 96.90, up to this level here, which is 97.43. So you got about 60 pips in there worth of a resistance zone. Now, but what I want to talk about here briefly is how the action of the upper time frame, I think, can provide some influence for you. In fact, I like even at some point to look at a monthly time frame. Number one, because it gives me a very wide range of vision. Okay, I can look all the way back here into 1995 and see that the market just has not traded up here for a long, long time. So I can see that. I can see the overall direction of the market. I can see that the trend really is coming from 2001. Here's the spike in 01. There's the higher high. In fact, here's the little dipper off of the monthly, and there's the trend. So the market has been making a very aggressive trend run up. This is a 32 bar moving average. This is a 64 bar, and here's the standard 200. But you can see the market pushed up, came down, found some support here, broke through that, found some support just above the midterm moving average. So when we're looking at the monthly or a higher time frame like the weekly and monthly, the whole point of this, once again, is to gain a perspective on the market. In fact, if we look at the last couple of months, you can see here is a classic expanding triangle. Last month was an outside bar. The month prior to that was a spinning top. So we've got a spinning top. This would be, in terms of candlesticks, more of a rickshaw man or a long-legged doji. Just indicating that the market is unable to make headway to the upside, unable to make headway to the downside. So I think we've got to be ready for a volatile move, whichever way it goes. But I'm going to, in my mind, start thinking in terms of where can the market possibly go. There's one point and there's the other. And I say that simply because these 2 points, this high and this low, are the boundary for traders' thinking. Remember, support and resistance is the physical result of what traders think. When the British pound was trading down here to that 92.90 level, what they obviously thought was they thought, hey, there is no way that the British pound is worth lower than 92.90. There's just no way. How do I know that? Because the market stopped there. Remember, let's not make this too complicated. Up here at right about 98.50, the trader said, hey, there is no way the British pound is worth more than 98.50. How do I know? Because they sold it. So these areas are going to pose pressure on the market. Because in order for the market to break above this level, and in order for the market to break below this level, the thinking has got to change. Now, I have no idea why traders are thinking that the pound is worth less than that and worth more than that. I don't really care. I just know that they do. But I can look back at the fundamental picture if I want and start to look at what was going on at this time. What has put pressure on the market at these 2 points? And then I can analyze when those same fundamental reasons come up, whether it's a non-farm payroll, an ISM, some kind of manufacturing, or a CPI number. That's when I can apply my research. And when those numbers come around again, if I get a certain reaction, say, for example, the number comes out very dollar bullish, then what I can probably expect is that the pound will go down again, because that's what influenced the pound to go down up here. If I look at the CPI number coming out, and it was very dollar bearish, and that came out down here, and the CPI comes out again dollar bearish, I'm going to expect the pound to go up because that's what caused it to go up back here.